Welcome everyone to our Ask the Experts webinar today. We'll begin the webcast in approximately 1 minute. Welcome everyone to our Ask the Experts webinar today. We appreciate each of you joining. We've got some compelling topics to discuss. My name is Drew Niehaus, a Managing Director at Riveron. I'm joined by three of my colleagues, Patrick Garrett, Zach McGinnis, and Sasha Morozova, all Managing Directors with the firm. The four of us, along with some of our colleagues, attended the virtual 2020 AICPA Conference on current SEC and PCAOB developments in December. It was a great 3-day event, and we're looking forward to sharing a number of the highlights from the conference with you today. Before we jump into the content, a few key reminders. On our website, riveron.com, you can access our previous Ask the Experts webinars. There are a number of great accounting and reporting topics hosted there. During the webinar, we will include 4 polling questions, each of which must be answered in order to qualify for CPE. Also, we welcome your questions. There's a Q&A option in Zoom that you can use. Please feel free to do that. We'll try to get to your questions, but if we don't, we will respond separately. The webinar evaluation form and CPE certificate will be emailed to you in about a week, along with access to the deck presented today and our contact info. Please note that while the on-demand version of the webinar will be available on our website, the on-demand version is not eligible for CPE. With that, let's get started with an overview of the conference, which will act as our agenda and a guide for the discussion today. As always, the conference presenters were primarily standard setters and regulators, along with some panelists who gathered to discuss the top accounting and reporting and auditing regulatory developments in discussion right now. The impact of COVID-19 was present throughout the conference, both in virtual presentation of the conference itself and then how it informed the content. A common theme throughout the conference was how regulators are supporting preparers and stakeholders who are working through a number of difficult and complex matters. This includes how the FASB is listening to stakeholders, how those stakeholders are influencing the standard setting agenda. And similarly, there was discussion on how the SEC has heard preparers and investors and are updating their rules accordingly. In addition to accounting and reporting items, there are a number of other emerging topics discussed, including environmental, social, and governance practices and disclosures, as well as auditor independence, both of which we'll spend some time discussing later on. But before we dive into the details, let's start off with a polling question. What do you expect to be the most challenging issue in this year's reporting cycle? A, impairments and going concern. B, accounting for financing transactions. C, remote work. D, ongoing issues from new standards. Or E, other or not applicable. And as people are responding here, I wanted to provide a little more color as to how the impact of COVID-19 informed the conference. In a moment, Sasha's going to discuss a number of the impacts of the pandemic on accounting, reporting, and disclosure. But with that being said, there was also a theme throughout the conference that businesses are still operating, preparers are still facing complex problems related to matters outside the pandemic. For example, in the update from the SEC's Office of the Chief Accountant, the presenters noted that despite the significant impact of COVID-19 on all businesses, and the fact that a number of SEC consultations were received related to the pandemic in the first half of the year, in Q3 and certainly in Q4, the consultations really returned to a focus of complex areas like principal versus agent determination, embedded derivatives, and variable interest entities. It was clear that regulators want to support stakeholders in working through issues faced in 2020, but throughout the conference, they were also looking ahead, returning to pre-pandemic agenda items, or rather post-pandemic agenda items. With that, it looks like the results of the polling question are in, and there's a pretty good split. Impairments and going concern seems to be the leader, which is not uncommon these days. And I think we are going to talk a little bit about those later. So Sasha, I'm going to turn it over to you to discuss how the accounting and disclosure impacts of COVID-19 were covered in the conference.
Thanks, Drew. Good morning or good afternoon, everyone. As Drew mentioned earlier, the impact of COVID on accounting and financial reporting were discussed throughout the conference. Generally, we can group those discussions into two areas, addressing the immediate accounting impacts and the broader disclosure and reporting impacts. From the guidance on year-end disclosures, the importance of proper detailed disclosures of COVID impacts on business was highlighted on several occasions. PCAOB also emphasized that auditors may need to perform additional procedures or perform procedures differently to respond to changes in a company business and internal controls. From the accounting impact, guidance was provided on critical accounting and reporting issues, including impairments, going concern analysis, like some of you noted in the polling question, and revenue recognition, along with other topics, which I will cover in the next few slides. To respond to COVID challenges, FASB also paused large standard-setting projects to focus on COVID-19 impacted items. They also delayed certain effective dates of new standards, such as AAC 842 leasing standard and AAC 326, which is a CECL standard. Now let's do a deeper dive on what impact COVID-19 is having on disclosures and financial reporting. During the conference, Division Deputy Chief Accountant, Mr. Gilmore, noted that companies were generally responsive to the pandemic-related disclosure guidance provided by SEC, and that the disclosures were, as he put it, pretty good. One of the key topics that was brought up was COVID-19 impact on non-GAAP measures. Specifically, Mr. Gilmore provided guidance on the use of non-GAAP measures to discuss the effects of the pandemic. He cautioned to avoid boilerplate disclosures, which is a recurring theme for non-GAAP measures even during previous conferences. He also provided a framework to help companies determine whether pandemic-related adjustments to arrive at non-GAAP measures are appropriate. He mentioned that those adjustments need to be directly attributable to pandemic, incremental to normal operations, and they should be based on actual and not hypothetical amounts. He noted that items such as hazard pay to employees and incremental expenses incurred to deep clean facilities are examples of adjustments that fit into this framework. However, he said that companies that make such adjustments should continue to monitor whether they are incremental to normal operations. For example, if high cleaning expenses become part of companies' normal operations and are expected to continue after the pandemic, making that adjustments would no longer be appropriate. Other examples of the adjustments that would not be appropriate would be estimated lost revenue, paying idled employees, and rent for idled facilities. In addition, Mr. Gilmore noted that it would not be appropriate to make adjustments to lost revenue because such modifications will be based on hypothetical amounts rather than on known amounts. He also noted the importance of focusing on long-term impacts of COVID-19. For example, if the company draws down debt because of liquidity concerns, it should provide company-specific disclosures about the long-term impact this debt will have, including how the company expects to repay the debt in the future. Further, it was observed that some registrants have had lengthy COVID-19 discussions on earnings calls, but the substance of those were not discussed in the SEC filings. He emphasized that companies should consider whether information discussed in earnings calls is material and should be discussed in periodic reports such as 10K and 10Qs. Moving on to COVID-19 impact on accounting and recent COVID-19 guidance issued by FASB. The chairman of FASB said that the pandemic continued to be top priority for the board. He noted that the board delayed certain effective dates for new standards to help reduce the burden on the companies during the pandemic. Specifically, FASB provided deferrals related to revenue recognition standard. Specifically, they delayed the effective date for private companies, primarily franchisors, who had not yet adopted the standard, with a new adoption day of January 1, 2021. Deferrals were also made to leasing standard, and it delayed the lease adoption standard to January 1, 2022 for privately held companies. And lastly, CECL standard was also delayed. And again, private companies now have until January 1, 2023 to adopt the standard. As part of its effort to address issues related to reference rate reform, the FASB provided preparers with the ability to bypass certain guidance related to the transition to LIBOR. The board recently approved the issuance of the final standard, which is expected in January 2021. To help companies deal with the accounting for troubled debt restructuring, the FASB provided guidance included in the CARES Act that allowed for any loan modifications or restructurings that were considered to be short-term modifications as a result of COVID-19 to be exempted from the troubled debt restructuring guidance. However, in order to qualify for this guidance, the company have to have two criteria to be met. The first one is the borrower can't be more than 30 days past due as of December 31st, 19. And the second criteria is modifications should be related to arrangements that defer or delay the payment of principal or interest or change the interest rate on the loan. The next two slides provide a summary of COVID-19 specific accounting hot topics which various presenters spoke about during various sessions throughout the conference. We wanted to summarize the impact on the few areas that were discussed. Starting with revenue recognition, so during the conference, it was highlighted that some companies may look for ways to mitigate the effect of the pandemic by offering various modifications to their contracts. Examples of such modifications include price concessions, discounts on the purchase of future goods or services, free goods or revisions to purchase commitment, to name a few. All those changes need to be evaluated for contract modification accounting to determine if the change should be accounted for prospectively or retrospectively, or whether there should be a change in allocation of transaction price and the timing of revenue recognition. Changes to employment agreements can also result in different accounting treatment based on the specific details of each arrangement and can vary quite a bit. For example, the accounting will vary based on whether severance payments relate to whether termination is voluntary, involuntary in accordance with pre-existing plan, or involuntary with or without future service. As it relates to stock options, changes to vesting of equity-based awards as a result of terminations can also result in stock option modification, accounting for which can be quite complex. As it relates to lease accounting, FASB has provided relief related to the accounting for rent concession resulting from the pandemic. Under the new guidance, rent concessions are treated as though they were part of the original contract and do not represent a modification. Also, companies may be required to test right-of-use asset for impairment as a result of business closures, supply chain disruptions, or other effects of the pandemic. Continued liquidity pressures related to COVID-19 have led to a greater number of debt restructurings, for example, to extend maturity date, reduce the interest rate, or ease covenant terms. Companies will need to determine whether changes to existing loans should be accounted for as troubled debt restructuring, a modification, or an extinguishment, all of which have specific individual disclosure requirements. And lastly, accounting for government assistance under CARES Act also poses lots of challenges for companies. Under PPP program, they need to evaluate whether the loan represents an advance payment, a grant, or tax incentive that may impact deferred taxes. With that, we are ready for our next polling question.
Thanks, Sasha. Interesting that it seems clear the regulators wanted to reinforce the message that now more than ever, accurate and reliable financial reporting is really important to investors and stakeholders. So with that, yeah, polling question number 2. How would you assess your company's implementation of the new accounting standards, leases and RevRec? A, complete and all tools related to implementation are running well. B, mostly complete, but still have more manual processes involved than we'd like. C, lots of manual workarounds involved in financial reporting every period, but getting to the right answer. D, finding new issues every reporting period. Or E, not applicable. While we're waiting, Patrick, did the SEC provide any feedback in the conference on how they've seen companies deal with COVID-related disclosures?
Yeah, thanks, Drew. And actually, in one of the first SEC speeches, Sagar Tietia, one of the SEC chief accountants, actually commented that he felt that the financial reporting ecosystem had responded very well to the challenging conditions of the pandemic, continuing to provide high-quality, timely information to investors. I think this is about as close to a collective pat on the back as accountants can get. So some really great feedback from the SEC and generally complimentary of the way that financial statement preparers, auditors, everyone have responded to continue to produce good, timely, detailed disclosures and financial information.
Yeah, that's right. So it looks like the results are in, and the leader here is, it's mostly complete, but more manual process involved than people like, which is kind of consistent with what I think we've heard in the market. And as system implementations are underway in the first or second year here, there's still some manual workarounds. So that makes sense based on what we've been hearing. Interesting to hear that. So Patrick, can you walk us through the accounting and standard setting matters discussed at the conference?
Sure. Really, as I think about the accounting update, really thinking about 2 sections, right? The FASB agenda and the forward-looking and where the FASB is looking at standard setting, and then a lot of guidance gained from the OCA or Office of the Chief Accountant speeches. So with that, let's jump into the FASB agenda. The FASB focused much of the year getting feedback on the implementation process for ASC 606 and ASC 842, as referenced in our prior polling question, while also finalizing timely standards like reference rate reform. The FASB also issued clarifying guidance around COVID hot topics like those discussed earlier, and where standard setting was needed, issued standards to help with the unusual issues that came from this type of economic crisis. Few highlights of its current forward-looking agenda I'd like to discuss. One ASU I'd like to mention that was not COVID related, but still relevant, was issued in August of 2020, ASU 2020-06, which simplified the accounting for convertible debt instruments. In summary, this standard concluded that if the conversion option did not meet the criteria to be bifurcated as an embedded derivative, then there's no need to further evaluate the option under the beneficial conversion feature and cash conversion feature guidance. This guidance is effective for calendar year ends beginning on January 1st, 2021. I think we can all look at this as a rather favorable development towards simplifying accounting analyses of complex transactions, especially given the complexity involved in the embedded derivative analysis of these options. Some additional highlights of the current upcoming agenda. A proposed ASU regarding how contract assets and liabilities would be recognized in business combinations. Essentially, the proposed ASU suggests that contract assets and liabilities would be measured in accordance with ASC 606 and not be adjusted to fair value. This would impact typical purchase accounting adjustments like the fair value haircut related to deferred revenue. This is in an effort to reduce the burden on the purchase accounting for preparers, which leads us to our next topic. As a result of purchase accounting, goodwill is always a sticky point for preparers. The FASB issued for comment an ASU where private companies would not assess goodwill for triggering events throughout the year, but rather just assess goodwill at its annual testing date. This would have the impact of taking into account how a company recovers from certain triggering events and would be relevant in this kind of environment. So if you had a triggering event in June and the company recovered by the time of its annual impairment testing date in October or December, whenever that is, you could take into account the whole year and not just focus on the triggering event time. Going on to the next topic, and more exciting news, I suppose, the FASB indicated that they are looking at the accounting for goodwill again. As we all know, the accounting for goodwill has been a particularly challenging issue for standard setters, and given the significant burdens that the current model puts on preparers, the FASB are once again revisiting it. While the FASB did not offer a straw man of what the new model would look like, Hilary Salo, the FASB technical director, mentioned that there was discussion about the amortization and impairment model, similar to other long-lived and intangible assets. One other topic on the FASB agenda that could be particularly impactful is further expansion of the required disclosures and segment reporting. Current guidance requires key measures of profit and loss that are provided to the CODM be disclosed. However, the FASB is considering expanding this to include significant expense items that are included in that measure of profit and loss regularly reviewed by the CODM. As we all know, putting together the segment disclosures can be challenging, and this would be a further expansion on that. However, investors have indicated that this is one of the more helpful disclosures within financial statements. And with that, let's move to the OCA speeches highlights. As most of you are aware, each year, members of the OCA provide a summary of specific consults they had with companies throughout the year in an effort to address trends and issues in reporting. The topics are typically chosen because they follow current trends. The speeches typically provide a non-authoritative GAAP best practice and are helpful for unusual circumstances. All speeches are archived and publicly available at the link shown on the slide. In addition to the accounting topics covered, this year the OCA highlighted several non-accounting topics that I'll briefly highlight. CAMS and Auditor Independence. The OCA highlighted that the first year of CAMS was complete and that the PCAOB had issued a report on the CAMS issued. The staff emphasized that the most informative CAMS as a best practice were the ones that were company-specific, addressing company-specific audit issues such as key estimates related to revenue recognition. The staff also highlighted auditor independence, as we will mention later, but one thing the OCA specifically noted was that companies should think about implementing internal processes to monitor services, affiliates, and have early discussions with auditors if a public offering is anywhere on the horizon. Now let's go to the key accounting topics covered. First, we'll take a look at revenue recognition, principal versus agent issues. There were two speeches at the conference that covered this issue. Both emphasized looking at the substance of the transaction and the substance of whether a company has control and can benefit from a good or service. As we all know, the control principle is key in evaluating all principal and agent revenue transactions and can often be gray, especially in the digital space. The first speech actually featured a consult related to a digital ad broker who placed ads on a publisher site through an auction process. The company would take momentary possession of the ad space on the publisher site as a result of the auction, which could have been an indicator of control. However, because the ad had already been supplied to the broker by the advertiser and the company had no ability to change what ad went into that space, the company determined it did not obtain the substantial economic benefit from the asset and recorded revenue as agent. In another example, a company sourced a commodity from a related party to fulfill its orders. The company had the ability to redirect the commodity from the related party to a different customer and took possession and title of the product. The company believed that it did not have full inventory risk because of an insurance policy protecting against loss on the inventory. Despite that, the staff considered that the company was acting as the principal in the transaction, squarely focusing on the ability to control the product and the substance of the transaction, regardless of other risk management policies that might exist or the evaluation of factors that may be non-determinative or less substantive, such as inventory risk. They looked at the total of the transaction and the true substance of the nature of it. The staff also highlighted an issue around the statement of cash flows. In the example, the staff walked through a company that had purchased PP&E from a customer, and due to the large amounts due to and from the vendor, and the relatively quick turn, the company considered it appropriate to net the purchases of PP&E against the customer's cash receipts in investing activities. The staff objected to this presentation as it did not represent the nature of the transactions, emphasizing that in most cases, gross presentation on the statement of cash flows is appropriate, which is a general guiding principle of cash flows. The staff also discussed an equity method investment consultation. The emphasis of the staff in this scenario was to evaluate all factors when assessing whether a company has significant influence over an investment. Just because they own less than 20% does not in and of itself mean they don't have significant influence if there are other factors in play. In the example the staff reviewed, the company also had an agreement to vote in concert with other shareholders that allowed them to elect a majority of board members, as well as managerial personnel with the investee. Based on the whole look at the facts, the staff determined that the company did indeed have significant influence and the equity method should be applied. Going on to other accounting topics that I'd like to highlight related to the impairment of right-of-use assets and the identification of performance obligations. On the impairment of right-of-use assets, the example from the staff emphasized the intersection between ASC 842 and ASC 360 with regards to impairing right-of-use assets, especially when a lease may be identified for abandonment but not yet abandoned. Especially in applying the recoverability test from ASC 360, a company may get to an answer where the asset group is not impaired. However, the right-of-use asset and an individual asset level should still be reviewed. In this scenario, where there was some time between identification of the lease for abandonment and actual abandonment, the company adjusted the amortization schedule of the asset to match its expected use. The staff agreed with this approach in the application of both sets of guidance. On identifying performance obligations, the staff once again highlighted that when it comes to software with future updates, there is significant judgment of the nature of factors involved in identifying the performance obligations, which can have a material impact on the financials. In this case, the ongoing updates were considered to be significant to the functionality of the software based on the nature of the updates. These updates were updating internal and third-party data sources used in a data analytics platform and were considered critical to its functionality. In that scenario, where the updates are critical, one performance obligation is considered appropriate. Those are some of the highlights from the accounting consult. There were several other topics discussed, such as VIE consolidation and evaluation of interest rate reset features in light of the LIBOR transition. And those are available in speeches on the SEC website. Drew, I'll hand on to you with the next polling question.
Yeah, thanks, Patrick. It's interesting to hear that even though we're a little bit removed from the public adoption data, some of the major new standards, those continue to be in heavy discussion and consultation with the staff. And, to that point, Patrick, you covered, one of the consults related to abandonment of leases, which is certainly an issue many faced last year. That's actually one of the topics that, or one of the questions that we had submitted today during the webcast. So thanks for covering that. Let's move on to the next polling question. The SEC has recently eased the burden on financial statement preparers while improving relevancy and impact to readers. So for your company, did this focus of the SEC result in A, less effort and better quality information, B, more effort and still better quality information, C, same effort, same quality of information, D, more effort, worse quality of information, or E, other or not applicable? And as we're waiting here, Zach, can you talk a little bit about the trends we're seeing in the SEC's recent changes with respect to financial reporting transparency and the quality of disclosures?
Yeah, for sure. Thanks, Drew. And thanks for everybody for joining today. At the end of the day, the SEC has definitely made some significant changes with respect to their financial reporting disclosure matters. So the answer to the question is a little bit of both between A and D. I think the goal here is more transparent, higher quality disclosures, right, with respect to things that we all know and are familiar with, right? And we'll go through some of those matters in a little bit, but definitely in my career personally, GAAP has changed quite a bit with 606 and 842 and 805 for the old people. But the SEC doesn't really change their rules very, very often, and it's pretty exciting to see what's happened over the last 12 months. So.
Yeah, for sure, and it remains to be seen what other changes come down the pike, especially as this. As investors and preparers kind of digest these changes, I think there's opportunity for even more. So it looks like the results are in, and really it seems like right now, a lot of people are saying it's the same effort and same quality of information. I'm curious if that'll change as time moves on and more preparers have the time to, kind of apply these new rule changes. So Zach, let's continue with an overview of the SEC rulemaking updates that were discussed over the course of the 3 days of the conference.
Yep, sounds good. So the next, 3 slides or so we'll go through, there was a lot that was discussed, right? The next 3 slides will kind of go through the key things that we heard and we feel, will be applicable to our clients' financial reporting matters. So if we go to the first, so the significance test and pro forma information updates, really, it was published in SEC 2020-118. So for folks that have been through the 305 significance calcs and been triggered on the pre-tax income basis, the SEC has now included a revenue component, right? And preparers now have the advantage of taking the more favorable of the 2 pieces of that calculation. So for example, if your pre-tax income test comes out to 70% and you're forced to do 2 years of 305 standalone audited financial statements of the target company, but the revenue is only 6%, then you no longer will have to do 305s. So that's a pretty huge change from what we all have lived over the last 2, 3, or 4 decades, really, on these significance rules. The investment test now, pull out your glossaries, but the investment test now has a term called aggregate worldwide market value, AWMV. And so for companies that are already SEC registrants, if they go through a significant transaction, the denominator now may be different than total assets, which we're all familiar with. A pre-IPOing or IPOing company obviously is stuck with the asset denominator. So just get to know this new term, aggregate worldwide market value, if you're a public company going through a potentially significant acquisition. And the calculation is based on a 5-day trailing pre or post month-end basis, whether or not you announce it or execute the deal. So the asset test, no changes. Just wanted to highlight that because that is obviously the third piece of the significance calcs there. And then on pro formas, what's interesting is the SEC is now allowing, as of 1/1/21, early adoption permitted, but now that we're doing this webinar in January, it's obviously applicable, but management synergies are now optional. So if you're pulling together a set of Article 11 pro formas, you now have the choice of, especially in the business combination situation, you have the option to include either G&A or revenue synergies, which obviously would be impactful if you're marketing or doing some financing related to a business combination event that you're entering into. From a form and content standpoint, there are now 3 buckets. So back in the day, it was, acquirer plus acquiree plus pro forma adjustments equals pro formas. Now the SEC is expecting you to have 3 different buckets: transaction accounting, autonomous entity, and management adjustments. Management adjustments being the synergies we just discussed, but But this is kind of a new set of guidance from how you actually do the pro formas. And then last but not least, non-recurring. So folks that have done pro formas in their career, the pro forma income statement has a concept of if it's not going to happen over 12 months, then you can't adjust for it in the pro forma income statement. That concept is now no longer applicable. So if, for example, if you buy a business, company A buys company B, and company B has a 5-month lived intangible, that amortization now is in play for a pro forma adjustment. So the next slide is around MBNA and Selected. So again, unprecedented changes. I know the word unprecedented is overused these days, but truly interesting. The first one is around the contractual obligations table. So folks that prepare MBNA, there's a nasty table that takes a lot of time to put together that no longer is applicable, right? The SEC does encourage folks to actually disclose any material events, but the traditional tabular format of the contractual obligations table is now no longer applicable. The second one is around selected financial data. So a non-EGC company, for example, that has to do 3 years of financial statements has to have 5 years of selecteds. That no longer is required. So that really is going to impact our clients, particularly when they have to prepare first-time carve-out financial statements and don't have that data for those super early years. This is a huge accommodation for those types of clients there. The third one is around selected quarterlies. Not a big issue for a company going through an IPO, but an existing registrant has to prepare a table of the past 8 quarters in a tabular format. That now is no longer required. So big accommodation for existing SEC registrants there. The fourth one actually for me is really exciting because in MBNA, as you know, you have to document your results of operations year over year and quarter over quarter. So the SEC now is allowing companies, if it's more helpful to the reader of the financial statements in the MBNA, to actually compare quarter over the preceding, the immediately preceding quarter. So for example, if you're doing, MBNA in the summer, you're going to have year over year in Q2 versus Q2. But now the SEC is actually going to let you, if you want, and if it's helpful, to do Q2 versus Q1. So that's pretty cool change there. And the last one is around revenue. This is more academic than actually practical, but the previous guidance was around increases in revenue. And the SEC now is kind of explicitly put in their guidance that preparers of MBNA should discuss, increases and decreases both quantitatively and qualitatively, right? Which most of our clients and for preparers of MBNA do already, but just more of an explicit change to the guidance there. So there is a link at the bottom of slide 22. If you want to read more, there's more. Obviously, there's probably 12 or 13 items. We just highlighted the top 5 there. So, and then the next one is around 310s. So this is an area that many people probably may not be that familiar with, but if you are, then you've lived through the pains of preparing 310 financial statements. So the SEC has changed a couple things. One is on scope, and the second is on form. The key thing here, again, the trend, as Drew mentioned earlier, the trend with SEC reporting matters is definitely in favor of the preparer lately. The SEC is becoming obviously more gentler and friendlier here, but so with respect to scope of 310s, previously, for example, if you had publicly registered debt, any subsidiary or guarantor sub had to be 100% owned. And now it could just be a consolidated subsidiary, right? So think 60% owned, 40% NCI. That entity now is in scope for the 310 accommodations. And accommodations meaning, the condensed consolidating tables that we used to do instead of full-blown financial statements, right? So the scope has gotten greater, and then on the form side, less periods. Basically, all that means is instead of having to do all the financial statements that are shown in the F pages of the parent, the 310 preparer and the subsidiary guarantors only have to show the last year and the last interim period. So they've chopped off some of those earlier periods. The actual presentation can be outside the F pages now. So no longer part of your audit financial statements, which is obviously an accommodation for the auditors and the procedures there. And then, they've introduced the summarized financial information instead of condensed consolidated tables, right? So, and then the last point is around non-financial disclosures. The SEC is now looking for more information about the actual deal itself, right? The issuer, the guarantor, and the structure and the terms and stuff like that. So, at the end of the day, the theme is pretty consistent. That the SEC is definitely being more compassionate for preparers of financial statements, and trying to encourage more higher quality financial reporting. So I think the next section I'll pass it off to Sasha for the other hot topics.
Thanks, Doug. So we wanted to highlight 3 topics that kind of hot topics for AICPA Conference, and they have been discussed in previous conferences as well, so they keep surfacing back. So we wanted to spend a few minutes on those. They include environmental, social, and governance disclosures, or ESG, auditor independence, and internal controls. So to start with the environmental, social, and governance disclosures, Center for Audit Quality Executive Director discussed investor requests for more transparent and accessible sustainability disclosures, the change of assessing a company's ESG practice without broadly adopted ESG reporting standards and framework. And the last topic that was discussed was the auditor's role in providing assurance over the sustainability information. The Center for Audit Quality also emphasized the rise of ESG reporting in response to increasing stakeholder expectations and highlighted the value of consistency in a global approach to sustainability accounting standards. AICPA President also echoed that sentiment, noting that much has been written on ESG reporting, both globally and in the United States, and that there needs to be a rational approach that is as universal as possible. Further, 3 things on ESG that were mentioned most often during the conference included the announcement of the International Integrated Reporting Council and the Sustainability Accounting Standards Board, SASB, that they plan to merge into a unified organization, which is a very important step in creating a single global corporate reporting framework for ESG reporting. Also, the International Federation of Accountants call for the IFRS Foundation was discussed to establish a global sustainability standard setter. And lastly, the release of the IFRS Foundation Trustees consultation paper on sustainability reporting for public comment to address demand for global sustainability standards and what role the IFRS Foundation might play. Now, to move on to the Audit Independence topic, speakers from both SEC and PCAOB noted that audit independence is an important area of focus, just like in previous years, and given the regulators continue to identify deficiencies that suggest audit firms' lack of processes and procedures needed to adequately comply with the independence requirements. The PCAOB noted 4 specific areas of focus related to audit independence requirements. They include documented firm policies, compliance with independence pre-approval rules for significant non-audit services, review of communications with audit committee on independence matters, and review of audit firms' responses to past violations. PCAOB also emphasized that the responsibility for audit independence does not just lie with the auditor alone. Instead, it continues to be a shared responsibility among audit committees, management, and the auditors, especially given the impact that any independence violations may have on current or future SEC filings. OCA Deputy Chief Accountant also highlighted a recent amendment to Rule 201 of Regulation SX that were intended to modernize the independence rules and bring them closer to PCAOB standards. There are various provisions of this rule, but among various provisions, there was a modification of the definition of the audit and professional engagement period to shorten the look-back period for domestic first-time filers such as IPOs and SPACs to 1 year, which conforms with the independence requirements of foreign private issuers. And there were also similar amendment to PCAOB rule in November 2020, which also was intended to align the regulation from PCAOB to the standard that was issued by SEC. And the last topic is on internal controls. In the panel discussion, Deputy Chief Accountant described the OCA's continued emphasis on robust internal controls as part of high-quality financial reporting. She noted that the ongoing pandemic has affected entities' day-to-day operations and has brought changes to work environment. She also cautioned that the move to a remote workforce may introduce additional challenges for business, especially as it relates to internal control environment. The panelists further emphasized the importance of evaluating whether changes in the work environment and to business risk will affect ICFR and whether the enhanced disclosures are necessary. Entities must disclose in their quarterly and annual filings any changes to internal controls that materially affect or are reasonably likely to materially affect their ICFR. And lastly, in light of current environment, it was noted that it is important for management to perform thorough evaluations to determine whether changes in internal controls are material. And with that, I think we're ready for our last polling question. Drew?
Yeah, thanks, Sasha. So speaking of internal controls, I think that's the topic of our final polling question. So have you experienced changes in internal control structure as the result of the impact of COVID-19? So A, yeah, we've experienced major changes in internal control structure. B, some modifications to key controls have been made. C, there have really only been minimal changes. D, not applicable, or a private company, or E, not applicable entirely. So while we're waiting, Sasha, can you share some of your experiences with companies who have been thinking through changes they need to make to controls in the wake of the pandemic this year?
Sure. I think the biggest challenge is when the companies experienced any reductions in headcounts and changes in their accounting and finance function. They have to revisit the prior year processes and ensure that same people still performing key controls and that there are no changes. And I think the other area, obviously, as we face more complex areas such as going concern and impairments, become more robust this year because of the pandemic. The companies need to take a closer look at the controls around those key estimates and management assumptions. So those are probably the two areas where we've seen internal controls have been impacted.
Yeah, I know that it seems like even with going concern specifically, a lot of auditors have a bit of a rebuttable presumption that companies are performing a more robust analysis this year, where in the past it's been a bit of a step zero, if you will, or a light qualitative analysis. So yeah, I think that's right, Sasha. So it looks like the results are in, and most companies are seeing minimal changes, which is good to hear. Followed by some modifications to key controls, which probably aligns with what you mentioned, Sasha, in terms of assumptions and estimates for companies that are doing more impairment analyses and things like that. Before we close, we received a few questions throughout the webinar that we'd like to take a moment to discuss. And So the first one, we received a question on ASC 842 for leases and the relief that the FASB issued last year. So it looks like the participants asking, what are some of the sticking points that companies have encountered or lessons they've learned if they took some of that release? Sasha, to put you on the spot here again, can you talk about that one?
Sure. So we actually have published a thought leadership piece on this topic. So if people would like to read more about it, it's available on our website. But at a high level, the relief enables lessees and lessors to pretty much opt out of modifying a lease if concessions are granted. And that reduces obviously the effort and time spent on subsequent accounting. Of course, we've seen many companies opt to take that relief, maybe with the exception of some smaller companies that maybe have it more on a manual process. They try not to change it too much. But with sophisticated lease software tools that's available, is really easy to process. And however, because the modification accounting is quite complex, right? You still have to assess it on kind of case-by-case basis. So a lot of companies did opt to take advantage of this relief and an effort to save time. And we've seen that actually with many other standards, like mentioned the actual deferral of lease standard for private companies and CSL. Many companies take advantage because it obviously saves them a lot of time and effort, especially in the times where their resources are constrained with remote work.
Yeah, that's interesting. Thanks for weighing in on that. One more. A question came in on the enforcement action session during the conference this year and whether anything came out of that session. Patrick, can you discuss some of what you heard at the conference on that?
Sure, Drew. I guess, I'm a big fan of the enforcement session of the conference, so thanks for throwing that over to me. But yeah, I thought at the conference, the enforcement session, the PCAOB and the SEC typically cover, several actions that were taken during the year, and the PCAOB highlighted the normal auditors behaving badly in terms of backdating work papers, falsifying documentation, or adding to the file after the fact, that kind of thing. But the SEC was particularly interesting in terms of their EPS initiative, and this is where they're using data analytics to analyze EPS disclosures to see that they make sense and that they are, to help them identify where there may be irregularities in the financial statements as a result of manipulation of earnings to get to a certain EPS number. I think this is generally a reflection of just where we're going in terms of more data analytics and more automation in terms of accounting, and we see that the SEC is responding with that as well on their side from starting to use data analytics to get smarter about how they find these irregularities and identify issues. So that was probably one of the more interesting things that I noted out of the enforcement section, other than the normal revenue recognition issues and things that were discussed.
Yeah, agreed. So thanks, Patrick. In closing, I want to highlight for everyone just some of our thought leadership on topics discussed today so you can use them as reference, such as the SEC updates to financial disclosure requirements for acquisitions and our recap on key takeaways from the conference, which you see linked here on this slide once we send the deck out. We really appreciate everyone joining today. We look forward to meeting with you again in future webinars. Enjoy the rest of your day, everyone. Thank you.